we have a really interesting panel at a very, I would say, at a very, very epic time in this country, where we're talking about sort of three things that could define the industry for future generations. And those in my mind are, in no particular order, what's happening from a regulatory climate standpoint. We've, in this room, perhaps with some of you and others, talked about interest rate caps for multiple years now, it feels. So I'll try to stay away from talking about interest rate caps today, because I think we have a light forwards, right, on that. But the regulatory climate is something that's on our minds. The effect of the fintech community and what it's doing to change banking, perhaps as we know it, perhaps even go as far as introducing forms of digital banks in our country, is perhaps something that we should all chat about. And then I think we wouldn't have done our job if we don't talk about the amount of M&A activity we see and are about to see. So some of the consolidations and why. Let me start out by inviting my friend Habil to talk about a little bit the voice of the industry. So if you think about Dr. Olaka's role as the CEO of the Kenyan Bankers Association, he perhaps today is the best voice of every bank and every CEO from a fraternity standpoint. So let me start with you and ask you, Bill, what is keeping our bank CEOs and C-suites awake at night?
I'm not a CEO of a bank, but I'm trying to imagine what is happening in the industry is possibly what will be keeping them awake all night. And I think one of the key things that comes to mind is the regulatory environment. The fact that you could wake up in the morning and by the end of day, there is a law that has been passed and become law that can affect your business substantially, and you have not had a chance to contribute or influence the direction in which it takes, it can be fairly frightening. Well, it has happened here, and we have seen it. I mean, you've just talked about the interest law. It can be introduced overnight. There's something called the order paper in Parliament. The order paper comes out like now for the next day. And you can check what is going to be discussed in Parliament the next day, and you could see something that could be of interest there. But there are cases where an MP could stand on the floor of the House and propose an amendment which was not in the order paper, and have it passed at the second reading, and it will fly through the third reading, and it becomes law. And the next thing is being signed into law. Now, in an environment like ours, that can be fairly frightening. And I'm sure for the CEOs, that's quite some frightening kind of, development. This is what you have been seeing in the papers, and that's to do with the threats of AML-CFT, money laundering and financing of terrorism, and the link between the two, and especially how it affects the business that you're running, given that with the current advancement in technology, it has become much, much easier for lack of a better word, the crooks to infiltrate the system. Now you could find yourself on the wrong side of the law, and now the regulators have become extremely sensitive, and the punitive measures are quite serious.
Great. And then Moses, just to bring you into this, from a C-suite view standpoint, is the regulatory environment for you the number one thing, or is there something else that in your role, I mean, you're a strategy guy, an investment banker by background, what is the first thing that is on your to-dos every day from a category standpoint?
Yeah, no, thank you, Vishal. I think Habil is quite spot on. We typically financial institutions exist to provide finance, right? So banking is the oxygen of commerce. So every day we wake up, we want to ensure there's finance that is permeating the commercial ecosystem. So
in an environment like, this room and outside and the economy, if you look at what's happening in our markets in terms of nimbleness and innovation and technology and speed, how are you finding some sort of balance between playing defensive and all these worries. And you said commercial enterprise is not even third on your list. So how do you find this balance to contribute to your customers and driving their outcomes?
If I don't play defensive, I lose my license. It's pretty straightforward. And without my license, I can't rethink commerce. So it's a very tough spot for banks and other highly regulated institutions to say, would I rather play defensive to keep my license, therefore then earn a return over the cycle? So it's a pretty tough one to not play defensive, frankly. But I think the broader question is does regulation follow innovation or the other way around? And that for me in this industry has not been fully answered. Do we let innovation in financial services to evolve much faster so regulation can catch up? Because they can't be at par, right? Or do we let regulation to evolve and therefore we wrap around regulation, innovation, and being there for the consumer?
But is there an awareness piece, Habil, where you sit with regulators today and explain this dilemma and educate them on the need to keep up with the technology and go faster and not over-regulate, but understand the role of technology and dovetail to that? Is there?
Absolutely. As KBA, one of our key roles is we sit in a vantage position. We get quite a bit of feedback from the customers, from the banks themselves, from various stakeholders, the regulators, the various stakeholders whom we engage. And on the basis of that, we then drive a number of initiatives in the industry in response to part of that feedback that we get. So part of it requires putting in place initiatives that are meant to address some of those concerns that have come from the market. And there are a number of initiatives that KBA has been driving along the line in response to that. But one of our key roles as well is policy advocacy. So we engage the various policy stakeholders. That is the regulators, for example, Central Bank of Kenya. There are other regulators for our markets, but Central Bank is the main regulator. We have got, for example, the National Treasury, parliamentarians. We engage them quite frequently. So there is a role that KBA is expected to play to ensure that we proactively engage the various stakeholders to ensure that the policy environment evolves in a way that is conducive for our members to play their due role. But coming back to the point that Moses mentioned about regulation and innovation, I think there's no better example to show what regulation can do to innovation than the very own example we have of M-Pesa. You see, M-Pesa would not possibly be there today had there not been what I can call regulatory innovation. M-Pesa was allowed to start operating in 2007. The law that allows Central Bank to regulate M-Pesa, the NPS Act, was enacted in 2014, 7 years after M-Pesa had been operating. And one of the reasons why M-Pesa is successful is partly because of that.
Which is the regulator missed it, or?
No, the regulator deliberately decided that instead of putting in a perimeter within which innovation to prosper, you let innovation develop, and then you look at the risks that are emanating from the innovation, and you can now control those risks as it goes along. And it was a deliberate decision, of course with the risks, but the risk has paid off with the current success of M-Pesa. And a number of banks are now leveraging on the success of M-Pesa to be able to also provide services to their consumers.
Is KBA sufficiently adversarial in its dialogue with those that make legislation? Is KBA sufficiently pushing the envelope back on some of these regulations, which at the end of the day, we as consumers pay for in speed, in delivery, in outcomes, and cost to capital? So are you finding it safe, easy, able in your role to push back and be adversarial?
Yeah, I think there's a point you're putting up there, which is the fact that to be effective in your advocacy role, having an adversary kind of approach to the relationship. You can still have a fairly amicable relationship with the partners and still be effective in your advocacy role without necessarily creating that friction between the two. But at times it becomes necessary for you to put your point forth in a forceful way so that you can be effective. And for that, I think KBA has tried to ensure that depending on the situation, you can be forceful if it requires to be so. And you have been in that kind of a situation with the respective, partners, especially, for example, the regulator. There are times when you have had a kind of friction that is not very conducive, but we sometimes have got to go that route to be able to put our message across. There are times when you have engaged the parliamentarians in a fairly abrasive way, I would say. You recall during the interest capping debates, there's quite some abrasive interactions between ourselves and the parliamentarians, which sometimes it's necessary for you to be able to put your point across.
So it's no surprise, given this landscape and environment, that we have disruptions, so to speak, in the marketplace from technology players, from fintech companies, right? So a conversation that I would have had with a domestic worker or a little supplier where they would sort of say, hey, would you help me get a loan from Equity Bank or Barclays, has now moved to, well, I can do this on my own using my phone and a small fintech company. So we're not surprised that this is happening. Is this something that we are supportive and are going to create an environment for them to grow and perform from an outcome standpoint to deliver customer expectation, or where are we going from that versus a regulatory climate? Are we going to regulate these guys and make them preoccupied with the same nightmares that you have?
Look, I mean, yeah, the nightmares are real, right? So it's a good point to start. But I think as we think about digital finance, fintechs, and try to understand what's happening in financial services, a couple of things are apparent. One is, over the very long term, all retail banks are going to be digital banks. It's clear to anyone who is looking at this landscape that that's going to be the case. A bit of background here on just where we find ourselves, why we find ourselves where we are. The emergence of platform economy. You've got big techs coming to provide a platform where everything else operates from. You've got 7 out of 10 most valuable companies being platform business model based companies, the likes of Apple, Amazon, Google, all these big guys, right? I think the first point of trip for banking was looking at these big techs or big companies, platform companies, as competitors. So these guys didn't come in to take profit away from banks. All they cared about was capturing the ecosystem. Amazon wants to make sure when you go to Amazon to do a purchase, click of a button, you can get a payment done and backed by finance if you don't have finance. They care about capturing that ecosystem. So they ran away with it. And banks began to deal their legacy systems to try and build something similar or catch up or partner, which is where it is. That's not the bigger threat. I think what you mentioned, for me, what I see as the bigger threat is this more niche, more nimble, more agile financial technology companies. And financial technology companies are not apps, by the way. So there's a nuance there that they come to the industry to build relationships with bank customers. They come to the industry to get data from the customers they build relationships with. And those two combined power what they do. I think those are the ones that pose a big threat to us as banks. We've got to think about whether we buy, build, renovate what we have, or partner with these guys, right? So to your point about regulation, I see an imbalance in both ways. So you can over-regulate the conventional banks and not regulate fintechs, and that's not good for the consumer. Or you can over-regulate fintechs, how you define fintechs, not regulate conventional banks as much, and that's not also good for the consumer. I think when you look at the globe around how this space has been regulated, so what the US did is they were pro-incumbents. The regulators said, we're not comfortable allowing non-bank financial technology companies, particularly from abroad, coming in to our conventional banking system. So as a result, they declined Ant Financial's deal to acquire MoneyGround, which had 350,000 retail outlets. So they're pretty taking a pro-incumbent view. The UK has kind of has kind of gone in the balance of allowing banks to have a safe regulatory sandbox to innovate that protects the consumer, so you're not exposing the consumer from whatever risks that innovation comes with, but also issuing licenses to neobanks. So there have been 15 neobanks taking away 30% of the market share in the UK banking system. So they're kind of saying, we don't feel so sorry for you guys in banking. We are not going to regulate these guys, but we're going to allow you an environment to create your own stuff. My view is, I think what Singapore is doing is what we should try and model around. So the Monetary Authority of Singapore, what they did was deliberately help banks evolve into building technology that is virtualizable, cloudable, scalable, all characteristics of a financial technology company. Over time, evolving financial technology companies to be service providers to banks, not service providers to consumers. So very cleverly, what they've done is put in an envelope banks and fintechs under their regulation. Perhaps one worth for the local regulators to look at.
We just took a stake in a digital bank in West Africa. Do you see that here? Do you see, I'm having conversations with some that are about to do a similar digital bank in Mauritius. These are fully licensed deposit-taking digital banks. Do you see that happening here in Kenya?
Look, I think just broadly, if I were just to comment on what I think banks should do as opposed to what we are doing. Look, it costs me today $7 to $10 to acquire a customer digitally. If you don't come to the branch, it's less than 1,000 shillings. If you come to the branch, it's $60 to $70, right? 10 times more. Then you've got to ask yourself the question, you've built all this legacy infrastructure and legacy branches, and you're in an era of new business models that cost of acquisition is that low, so what do you do? Couple of things. You either choose to buy, so buy your own outfit, like just what you said. So enter into new markets or existing markets cheaply. As you build innovation around who you're buying or who you're working with or who you're building, to make sure you're building products that are leapfrogging you as an institution while you fix your legacy, which you have to renovate over time. So we can't all of a sudden close half of the branches, right? So we cannot do that. It's not just that easy to do. So over time, banks then have to chase that future parity. At what point do you become at par with those who are good at digital finance? So you can buy, and that's a route. You can choose to build. Go buy your own tech platform, integrate it, or run it separately. That's an option. Or you can partner, which is, I think, where I'm more skewed towards, knowing that financial technology companies or digital standalone monoline banks have certain advantages you don't have. You have advantages that they don't have. There's a reason why Apple partnered with Goldman Sachs to launch Apple Card, because they cannot underwrite credit. A bank has to backstop underwrite credit and manage the risk. They're licensed to do that. So you bring your advantage that way, and you buy innovation, which you can scale quickly. Combined, you build a powerhouse. I think for the consumer, I always say that the consumer is loyal to lifestyle and loyal to convenience. If you think about the Kenyan consumer today, if you're 10 years old, you're younger than M-Pesa. So for you, M-Pesa is quite an old technology. So for a bank to come and say, I'm going to make sure you clear your check in a day, that's quite Stone Age. So how do banks then partner with the likes of M-Pesa or Safaricom or other telcos or other financial players to serve what the consumer wants? Convenience and hyper-personalization, which is I get what I want when I want it at the price I want it. It's very difficult today for a modern consumer to tell you who their bank is. They've got one person who backstops their payments, who's giving them a credit card, where you get discounts for your film, or a bookstore which is financed by a bank. So then as banks think about what route to take, do you buy, do you partner, do you build, those are considerations to make. I agree fully with Habil that at the end of the day, if it's not wrapped around the advantages to the consumer, then you're out of the game because you're not, who are you building for?
Look, I got a call from one of my banks, I won't tell you who, about a week ago, to renew some of my KYC. And when I looked at the request to renew my KYC, I was thinking about, sadly, the environment we live in. That request to renew my compliance seemed 1960s. What is the bank even going to do with copies of my passport and pictures? And why do you need 2 picture copies? And what are you going to do with all this stuff? And where are you going to put it? So is the bank truly, is the banking community truly keeping up with where technology is and the environment around it?
I think that is an interesting perspective, partly because, and by the way, banking is one of the most heavily regulated sectors. So some of the requests that, for instance, we want your residential address or your passport details or such kind of details is actually driven more by the regulator. And as much as you could try to use the developments in technology to satisfy some of them, sometimes the regulatory requirements are still miles behind. So as you try to advance, you will not actually be complying because the compliance requirements are still
Bill, sorry, this goes back to awareness and advocacy, right? So are we, as an industry, saying to the regulator that we're living in the age of artificial intelligence? We're living in the age of machine learning. I could get, my eyeballs scanned. I could have biometric readings. What are you ever going to do with my residential address, right? A biometric scan or reading, doing an eye scan or using artificial intelligence is far more valuable to you as a regulator. So can we build technology and solutions that are in keeping with what's happening in our real world? Because what are you going to do with my residential address?
Yeah, so these are real conversations that happen with the regulator, Vishal. I don't think it's lack of collaboration or lack of trying to, for lack of a better word, have the regulator see the reality of the lay of the land. I think those conversations happen very robustly. So what do we do, right? So what do banks really do? Suffice to say that then if you're a bank and you're aware of those legacy problem of KYC is part of 800 pages of regulation you've got to comply with, which is here not going anywhere, then you've got to answer the question in a different way. How do you build something for a new whole ecosystem that requires no KYC or requires no financial data to be provided for you to get a loan or to open an account? So what we've done at Barclays with the Timisa is to say, we will let our conventional bank continue to do what it does. Continue to follow the regulation, continue to be brick and mortar, digitize it as much as we can at the speed of regulation, because we can't break the law. But then we will build a standalone virtual bank that you don't have to ever walk into a branch or provide any documentation for you to open a savings account or get an insurance policy or get a loan. So that's how banks are trying to navigate it. How do I go to this whole new ecosystem? And by the way, the ecosystem is not necessarily new customers. It could be the same Vishal being asked for KYC on the conventional side, being told, by the way, go to your app and transact or get an insurance policy or get a financial planning policy. So that's how we're trying to balance it. As over time, this collaboration with the regulator evolves to a point where, in fact, for us, we see a point where a few years from now, we'll be asking the conventional bank, why do you really exist? Because the whole Timisa virtual bank is a fully standalone digital bank that operates with bigger scale, more revenue, et cetera, et cetera. So, and I think more banks are doing that. It's not just ourselves.
Sure, speaking of why do you exist, let's talk about consolidations, right? Is this for real? I mean, I saw 3 law firms and 2 investment bankers in over the course of Monday through today. And everybody seems to be busy thinking about a M&A deal in the banking sector. But we've been talking about this stuff in our market for the last decade. Is this for real?
I think on the issue of consolidation, we have been at it for quite some bit of time. If you recall, about 2-3 years ago, the CS National Treasury proposed an increase of the core capital of banks from the current 1 billion to 5 billion. And I think the intention was to force consolidation from a regulatory approach. It didn't go through, but in my own view, even if it had gone through, if that law had gone through, it would not have achieved the intended objective of consolidation. But I think what you're seeing now is the market-driven consolidation where players are identifying synergies between themselves and then seeing the best way to, to combine. Some of the deals that we are seeing coming to the surface today have been under discussion for quite some bit of time, where the partners are trying to weigh the synergies and trying to see the positive combination between the entities.
Sorry if I could interrupt you. Is it driven by synergies and growth, or is it driven by cost of compliance and over-regulation?
It could be both. I mean, it could be either you see synergies, or it could be driven by the fact that the cost of compliance is on the higher side. But still, in order to bring your cost down, you'll have to identify a partner whom you can, have, a positive combination with. I think at the end of the day, between the two, where you are forced by the regulator, and you have seen in markets where the regulator actually comes in and forces consolidation, and some of those end up into marriages that don't stand the test of time with the time. And there are a number of examples that can be given where the regulator comes in, forces that kind of combination, and subsequently start seeing problems, and the entity cannot survive thereafter. But I think what makes me excited about the current Kenyan scenario is that it's not regulator driven, but it's driven by the market itself.
So is there a prediction? Are we going to see 2 more deals announced, 3 more deals announced?
I don't know about that.
You're not buying anybody?
But another trick question. I agree with Habil that so when you think about markets where banking has consolidated, right? So there are 3 apparent ways in which it happens. One is the regulator sees weak banks that are either systemic or could be of contention risk and say, hang on, someone needs to pick you up. And we saw that with some of the 2 deals in some of the banks a while back. And there's the route where banks want to gain entry into new markets or double down their power in existing markets, and they go for scale. They say, for us to get a license to market X, we need to buy a bank. I think Kenya as an economy can be underwritten by fewer banks. That's my own assessment. We probably need 5 to 6 material banks that control 60% of market share. Then 10 to 15 niche players. They must exist, the niche players. They serve very specific segments. The bank to population ratio here is 1:1, 1:3 in South Africa, 1:10 in Nigeria. So from a scale point of view, we are overbanked if you look at those ratios. What then says to me, if you've got the strategic appetite to acquire and you've got the currency to do it, whether shares or not, and there's a wave, there's a time to do it. I don't think it's going to be a wave per se. I think it's going to be opportunistic. Where can I, to Habil's point, do I see synergies? We may continue to see pressure from entities that have got overlapping shareholders. The other deal, right? So where there's, and it's the right thing to do to simplify your shareholder structure. So whether there's a good deal or a bad deal, if the shareholder wins in terms of simplifying the ownership structure, you go for it. So it's likely to see more, in my view, and likely to see certain mistakes being made, and it's likely to see good deals coming.
I mean, if I can just add on to it, we have been having this debate for quite some bit of time in terms of consolidation. Is it good for the Kenyan market? Are we overbanked, or are we not overbanked? But my own view is that there is no empirical evidence to show, banks' ratio to population or to GDP or whatever it is. I think each market is unique. if you look at the respective markets, you find that each of them is unique. And the critical thing is that you should have specific banks serving some specific needs for clients. And you'll have, like, for example, in the case of Kenya, I think the target has more or less been the smaller banks. Are they necessary, or should they be combined into larger banks? And yet those banks are actually serving some specific niche of customers. And if the consolidation will lead to those customers not having somebody to serve them, then there is a problem. And I think as long as we are careful to ensure that those customers continue to be served, we have made so much progress in terms of financial inclusion. The FSD report, the one that was released recently, you can see the progress that Kenya has made in terms of financial inclusion. Now, those gains, we do not want to lose them by virtue of having some segment of the market that was initially accessing services being denied by virtue of moving into a consolidation environment. Now, so in summary, I think the critical thing is the fact that consolidation is positive, but I think we need to be sure that the segments that are currently being served are not denied access going forward.